Hello, and welcome to this week's edition of Tax in 10 with me, Rachel de Souza, and Andrew Robbins. We're both tax partners in RSM's London office and have a wealth of experience in dealing with a wide range of private client matters. As you now know, your feedback is valuable to us, so please do keep it coming, especially if you have some thoughts on any future topics you would like us to cover. We can be contacted at rachel.desouza@rsmuk.com and andrew.robbins@rsmuk.com. We have had a few requests to cover some odds and ends, so we will occasionally cover some of these so-called tax quirks. This is often going to be a subject that you might have heard about but are unsure of its significance. Today's quirk is capital tax treaties. So we need to ask, first of all, what is a capital tax treaty? Actually, Andrew, perhaps we ought to start with what is a tax treaty at all?
Actually, I think that's probably sensible, because tax treaties are things that you may have heard of, but there's a very good chance you'll never have actually delved into one or gone through the pain of reading the things. At heart, it's actually pretty straightforward. So they get called different things, but a tax treaty or a double tax treaty is an agreement between two governments which tells everybody which government gets to collect tax and in what circumstances. This is really relevant where you've got conflicting domestic laws. Now, the UK has a really good network of actually over 130 tax treaties, which means it's one of the world's largest. But as you will have noticed, there are more than 130 countries in the world. So even the UK doesn't have tax treaties with everybody. Where the treaties do exist, they provide the framework for how each source of income and gains should be dealt with. And as the name suggests, it's a double tax treaty, so it tells you how to avoid being taxed twice on the same thing. Just to sort of give an example of this in practice, so let's say I'm a Brit living in France and I receive UK pension income. Who is allowed to tax that pension? So the French authorities might be saying, well, Andrew, you're living in France. We in France think it's only right that our citizens, our residents should be taxed. We want the money. But the UK is going to say, well, hang on a minute. It's a UK pension. It's being paid out of the UK. We want to have tax on this as well, or instead. So under the domestic law, both countries potentially have the right to tax me. And in that situation, the double tax treaty comes in to sort of decide who has what rights. So the treaty will tell you how different types of income or gain will be taxed. And it can work in different ways. So sometimes only one country has the right to tax. So it might be that if I'm living in France, France has exclusive rights to tax me and the UK has no rights at all. In other situations, under the double tax treaty, both countries have the right to tax. And in that situation, the treaty will tell us which country I have to pay my tax over to, and then the other country has to give me credit for the tax that I've suffered. So if in my example, if France had the primary taxing right, but the UK also had a taxing right, then I would have to pay my tax in France. I would also have to declare the income in the UK, but my UK tax liability would be reduced by the French tax I've already paid.
Okay, that all makes perfect sense. And I think, to be fair, I think most people understand that the UK does have a treaty network, but probably what they're not aware is that these treaties of over 130 that you mentioned cover income and capital gains. But actually, what they don't cover is estate taxes or inheritance taxes. So the question really then becomes, well, that's all well and good, but what actually happens in regard of death, estate taxes and inheritance taxes? And the answer to that is almost you could guess what it is. Well, a treaty needs to tell us, or needs to tell the governments, what we're going to do in the case of death. But whilst we have this really extensive network of treaties covering income and capital gains, we only have capital tax treaties with 11 other countries. So it's a far, far reduced number of countries where the two systems are looked at in this way. But just like those income and capital gains tax treaties, the capital tax treaties are also designed to prevent double taxation where gift or inheritance taxes are due. The really interesting thing about our capital tax treaty network is that there is a particular quirk in 4 of these treaties which can give an unexpected benefit on death. But to understand this, we have to go back to basics. And here we're looking at our non-domiciled individuals. And if you remember, they're only taxed on UK situs assets on death. Whereas if I'm a UK domiciled or a deemed domiciled person, I'm taxed on my worldwide assets. And again, just as a reminder for everyone, if you are non-domiciled, you become deemed domiciled once you've been in the UK for 15 out of the last 20 years. So going back to our quirks, if my circumstances are such that they fall within what I call the Fab 4, these Fab 4 treaties for capital taxes, and I have been resident in the UK for a long time, my expectation may well be that my worldwide assets are subject to IHT on my death. However, the correct position is that under the terms of these capital tax treaties, my non-dom status actually comes back into play for inheritance tax purposes on my death. In other words, the deemed dom status is overridden and I am treated for capital tax treaty purposes as a non-domiciled person on my death. And that means that actually it's only my UK estate that is subject to IHT.
And this is actually one of those situations where, as tax advisors, we can really sort of pull a rabbit out of a hat for a client, because the number of clients who are aware of this particular quirk is tiny. So you can be really impressive if you've got somebody who is coming to you to take inheritance tax planning advice, having been living in the UK for a long time. It's a real opportunity to give them a better result than they were ever expecting. Now, your Fab 4 countries, which to the rest of the world means Italy, Pakistan, India and France, just have this fantastic, I almost want to call it a loophole. I mean, it's not a loophole. It's not a failure or anything. It just comes from the fact that these treaties are really old. So basically, the treaties were created before 1984, which is the year in which the modern UK inheritance tax system came in. So prior to that, we didn't have the concept of deemed domicile, which means that those treaties didn't take account of deemed domicile when the treaties were written. I've been saying for years it's only a matter of time before these treaties are renegotiated and this opportunity will go away. But so far I've been proved wrong, and I do start to wonder actually whether there's always something more important to do. So I'm sure at some point the treaty will be renegotiated, but I imagine it's not high on anybody's list of tax changes to make. So from a practical perspective, why does any of this matter? Well, let's take an example. that you're an Indian domiciled person who's lived in the UK for more than 20 years, and you've got a wide range of assets in the UK and outside of the UK. If you take the right steps so that the UK-India Capital Taxes Treaty will apply, then your non-UK assets will not be subject to IHT on your death. So at a stroke, by making sure you fall within the provisions of the treaty, you've saved 40% of the value of your worldwide assets at hardly any cost, really. And it can get better than that, because if you arrange to, for example, if I've got UK investments, maybe I want to put those under a non-UK company, so that now I don't own UK shares, I own shares in a foreign company that owns UK shares. That again takes those UK assets out of the scope of inheritance tax. So you can even do better than your non-UK assets. You can make it wider. The other thing that for people in this situation it totally changes is that if I die holding these non-UK assets, there's no inheritance tax. If I give those assets away during my lifetime and I die within 7 years of the gift, the provisions of the treaty don't apply. And in that situation, I am still deemed domiciled at the time I made the gift, and there is IHT. So actually, if you are from Italy, Pakistan, India, or France, you could be worse off if you make a gift during your lifetime, and better off if you keep it until you die. At least that would be my excuse for not giving anything away to my children.
Well, I just think you're just curmudgeonly, to be honest.
Well, that too.
Brilliant. So anyway, that is really useful to know, and we can now consider estate planning in a different light, but only for those chosen few. Now, I have a recommendation for you this week. I've just finished reading a really good book, very different, because you have to pick up the story by an exchange of email correspondence. So it's it's not a regular book with proper chapters in and so on, which made it quite good, I think. Anyway, it's called The Appeal. It's by Janice Hallett, and I've seen a quote. I can't remember it word for word, but more or less it says, well, it trumps Richard Osman's books, out of the water. So a good recommendation there, both from me and from other people.
So Rachel, is this a thriller or is it a
crime?
A romance or crime?
Crime and sort of legal, but more about crime and trying to work, well, as ever, who done the dirty deed. Okay. Yeah, good stuff. Right, everyone. Thanks, everyone, for listening. As always, please let us have your comments and feedback. We can be contacted on rachel.d'Souza@rsmuk.com and andrew.robbins@rsmuk.com. Bye for now.
Bye.